Today we are going to discuss about bond as an investment and what bonds actually are, because eventually there are so many products, and we have heard about stocks and bonds and these portfolios so many times, but the concepts sometimes are not clear. And our main purpose is to simplify this for you. So what we are going to do is make sure that you understand bonds very simply and what they are. So few things which you need to know about bonds. Shares or stocks, they give you ownership rights in a business. So when you buy Amazon shares, when you buy Apple shares, you are kind of a part owner in the company. So you are more of an investor when you are buying a stock of a company. You are a business partner, I should say. But when you are buying a bond represents loan, loan from you. So when you are buying a bond, you become a bond holder, and the price at which you are buying a bond from the issuer, you become the buyer, and you represent that you are paying a loan to the issuer of the bond. So by buying a bond, you become a lender to someone who is in need of money. And this is something which is very important. And again, as I said, I'm trying to make it more and more simpler. But you must know the bond market is by far the largest securities market in the world, because the bond market, it provides investors with limitless investment options, and many investors are already familiar with that aspect of the market. But then obviously, as the number of new product comes into, even sometimes a bond expert is also challenged to keep pace. So that is why I must tell you that the bond market is very huge, and the main reason is that it's a fixed income product. And I'm telling you that this earlier people used to see bonds as just a means of earning interest and preserving their capital. But now bonds have actually evolved into $100 trillion global marketplace, and it can provide you a lot of benefits, especially in last 2 or 3 years. Bonds have actually become a go-to investor product. So obviously there are, these are the products which are being talked about. And as I said, what makes bond a bond? It's, we talk about bond as a loan. So if you're purchaser of the bond, right? So for you, a bond is a loan, or when you are buying a bond as a bond purchaser, or if you're a holder of the bond, you are giving a loan to the maker or the issuer of the bond. So somebody who has issued the bond. Now there, it could be a government, it could be a company, it could be a municipal authority which would be in need of money to carry out their operations. And what they do, they need capital time to time. Now, an investor who buys a government issued bond is basically lending the money to the government, right? And guys, please, if you don't understand anything, you definitely can put up a question and you can definitely ask. So when we look at the bonds, as I said, it's a debt instrument, right? It's a loan instrument, as we call it. And just to, as I said, make it more simpler to understand, when we talk about bonds or what bonds actually are, as I said, if you buy a government bond, you are lending government the money. If you as a bond holder are buying a corporate bond, then you are lending money to a company. And just like a loan, that bond will pay interest periodically, and it will repay the principal at a stated time, and that stated time is known as the maturity of the bond, right? I'll give you an example, so please listen out. And if you want to note something down, if you want to uh, have a sort of information, or if you want to write something down, let's say that there is a corporation. They let's say there's a company, for example, and that company wants to build a new manufacturing plant for which they require $1 million. Now, what that company do to get that $1 million, they decide to issue a bond offering, right? Now, that company might decide that we will sell 1,000 bonds to 1,000 investors. So basically, we'll sell 1,000 bonds, and every bond will be of $1,000 each. So you need $1 million. So the company decided that to make this plant, I need $1 million. So what we can do, we can issue 1,000 bonds, and one bond will have a value of $1,000. So in this case, so will also make you familiar with the terminology of the bond. When we talk about bonds, we'll tell you the exact terminology. What is the size, issue size? What is the face value? What is the coupon? What is the maturity date? And that is why, as I said, that let's say to finish that plant, which is $1 million, the company decides that we will issue 1,000 bonds, and every bond will have a value of $1,000. So 1,000 bonds multiplied by $1,000 total is 1 million. Now, in this case, that $1,000, which is the value of each bond, it is called face value or the par value. Please note it down somewhere if you can. These are some important terminologies. I'm sure a lot of you already know about bonds, but I think it's a very mixed crowd, and I'm sure a lot of you have not done bonds before. So I would just want to introduce you to the basic understanding of how it is, and then we'll move on to the further concepts and understanding that how it can be a part of our portfolio also. Now, as I said, that $1,000 at which the bond is issued, that becomes the face value or the par value. And that company which has issued the bonds, we call that company as the bond issuer of the bond. Okay. And that company also determines that how much annual interest rate, which is called coupon, and a time frame within which that company will repay the principal amount, which is $1 million. That is called the maturity period. Okay. So the bond issuer, in case of this company, the company is the bond issuer. They will decide that how much is the interest rate which they have to pay. That interest rate is called as the coupon. Please remember the terminology because you will always hear bond with a coupon. So coupon means the interest which you receive for giving loan to this particular company, and they will decide a time frame within which they will repay the principal amount of $1 million. Now, this interest which is set, this interest also has some sort of base. So the issuer of the bond, which is in this case is the company, the most of the time they will take into account what are the current interest rates going on, right? So obviously that interest needs to be competitive. If you compare this company's bond to someone else, they want to make it more competitive because they need the money, so it should be attractive to the investors, right? So let's say, for example, this company may decide to sell a 5-year bond with an annual fixed interest of 5%. So at the end of 5 years, when the bond reaches to the maturity, that company repays the $1,000 face value to each bondholder. So by the end of 5 years, you will get your capital back. Plus, for entire 5 years, every year you will receive 5% as the coupon. How long it takes for a bond to reach maturity, that can play a very important role in the amount of risk, right? Because a $1 million bond repaid in 5 years, it actually is less riskier than a $1 million bond repaid in 30 years, because so many factors they come into account, right? They could have a negative impact. Maybe in next 30 years that company goes out of business or gets bankrupt, so they are not able to pay the coupon or the principal amount. But in 5 years, which is a short term duration, the risk is less, right? So the additional risk by a longer maturity bond is directly related to the coupon, right? So issuer of the bond will obviously pay a higher interest for a long term bond. That is another reason that why a lot of investors they invest into longer term bonds, because they are seeking higher interest, right? And that is where, because they incur additional risk, they are looking for additional return. Now every bond carries some risk. Now I'm sure that right now there's a question which is coming in, that are bonds risk free? Now let me be very clear over here. Any bond or any kind of investment, in fact, it is not risk free. There is no such thing as risk free, and I'm sure by now everybody knows that risk free is not a concept. There's always an element of risk. If you're doing an investment, it's either high risk, low risk, or relatively less riskier, as we call it. Does this coupon is a guaranteed income? Again, I would refrain to use the word guarantee, because when you give loan to someone, you have fixed a return on it. You have, if you give a loan to your friend, you are sure that your friend will pay you back, and let's say in 2 years, and for the time he's using your money, he will pay you a fixed interest. So you're thinking this is such a great and easy investment, right? Because you will be paid fixed interest, and at the same time after 2 years you will get your money back. So why invest anywhere else? But in those 2 years, if your friend runs out of the business or he does not have the money to pay you back, then all of a sudden that less riskier investment became a hell lot riskier. So that is why there is no such thing as guaranteed or risk free. But that is why you look at the credibility of the bond, right? You have to look the credibility of the issuer, because that is really important. Looking at the credibility of the issuer of the bond. You're giving loan to a person who has a history of paying you back. He's a very close friend of yours. He has a lot of money. He has a great business. So even if you give him a loan, you know that I may charge him less because at least he is giving my money back on time. On the other hand, if you give loan to a person who has a history of not paying you, but this time he is promising that he will pay, you know your risk is high. So what do? You say, okay, I'm going to take this risk, but you have to give me a higher rate of interest because my risk is higher with you. This is exactly how bond investments would work. So there is a risk of default, but it depends. If you're giving loan to the US government, then in that case, your risk is less because you don't expect the US government to get bankrupt. That could start a series of collapses. But at the same time, if you buy a Maldivian bond, then maybe there is a point where you might face some risk. Or if you buy a Venezuelan bond, for example, those kind of bonds will give you a much higher return because their interest rates is much high, because the risk is much higher. So this is a constant choice between which bond to buy, which issuer to look at, and how do I select the right issuer? Which are these agencies which rate the bonds? Should I look at a A plus bond? Should I look at a B plus bond? And how do I select which bond to invest in? How bond prices go up and down. This is also something what we are going to cover today. So this is something which is really important. Now there are different types of bonds. As I said, that bonds also have a certain amount of risk, but then there are things which determine the price of the bonds also. We talked about that there are a lot of bonds which carry some kind of risk, and again, the major risk is a default or the issuer not being able to fully repay the loan. So there are a lot of these credit rating services. They assess the default risk, they assess the credit risk of the bond, and then they publish these ratings that help the investors to evaluate the risk, right? And obviously, if there is a bond issuer which has a high credit rating, they will pay a lower interest, right? But if somebody has a low credit rating, then they will attract investors by paying a higher interest. Again, investors who purchase bonds with lower credit rating, they can earn higher returns but then they will bear the additional risk of default by the bond issuer. So this needs to be very clear. It does not mean that you're going to always lose. It's just the bond which you're buying and the credit rating, the credibility of that particular company or that particular government is not that great in the market. So they are ready to offer a higher interest. So when you buy that bond, if it pays off, it pays off. But if it gets defaulted, you're taking that risk. But that risk is being compensated to you by getting a higher return. So this is something which is really important, guys. Now, coming to the idea, how many kinds of bonds are there? Basically, what kind of bonds are available, like how many issuers, how many kinds of issuers they can be, and how many types of bonds there can be. And these are some broad categories to look at. Obviously there are different kinds of bonds, and it continues to go, but few bonds which you should understand, like for example, starting with the first category, when we are looking fixed rate bonds. Fixed rate bonds, also known as fixed coupon bonds. Fixed coupon, as I said, fixed interest bonds. Their coupon or the interest which you receive on these bonds do not change even if the interest rates in the overall market has changed. But this particular bond which you have purchased, the coupon is fixed in it. I'll give you an example. Yesterday, Central Bank of US cut down the interest rate by 50 basis points, which means 0.5%. So earlier interest rate in US, the cost of borrowing money, or if you give somebody loan, the interest rate which you would expect would be around 5 to 5.2%. Now, yesterday onwards, this interest rates, because the rate has been cut down by 0.5%, this could go to 4.5%. Now, imagine you gave a loan to someone and he promised you to pay 5% because that was the interest rate and that was decided as per the environment. But now interest rates are less in the market. Now it is 4.5%. So should you receive less is the question. If in the bond it is mentioned that it's a fixed rate bond, then you will still receive 5%. This is called a fixed rate bond. On the other side, if interest rates go up from 5, if it became 6, you will still receive 5%. So fixed coupon bonds or fixed rate bonds are those kind of bonds which, when you buy, allows you to receive a fixed coupon till the maturity of that bond. If you have purchased a 30-year fixed coupon bond, for the entire maturity of those 30 years, you will continue to receive a fixed coupon. It does not matter what is the interest rate in the market, you will receive the fixed interest or the coupon which has been told you. Second is the zero coupon bond. How the zero coupon bond works? You know the important feature of the bond is the coupon. So how a zero coupon bond works? Normally, when you buy a bond, it pays you periodic interest payments, right? So you buy a bond for $1,000, it pays you a fixed interest of 5% year on year until the bond matures or until you sell the bond. In case of a zero coupon bond, there are no periodic payments, but instead of selling that bond to you for 1000, the company would offer you a discount on it, which later on, once the bond matures, it will be redeemed at the full par value. What was the par value? 1000. But the company issued a discount when you purchase that bond, let's say 990. But by the end of the maturity of the bond, you will receive 1000. So you will receive $10 extra, and that $10 extra would be the compensation of that in those interest payments which you have not received. So a zero coupon bond does not make any periodic payments, but in that case the bonds which you buy at a discount, and later on when the bond matures you receive the full par value. So if you're buying a bond at 800, by the end of the maturity you will receive 1000. So you don't receive any coupons, but you receive a higher capital on that. So those are called zero coupon bonds. A lot of people, they invest into zero coupon bonds, they buy zero coupon bonds, and I'll try to share a portfolio with you where there are a lot of zero coupon bonds also given, and you can always check that also. Then there is obviously there are different kinds of bonds, as I said. Then there are high yield bonds, there are corporate bonds, there are convertible bonds, municipal bonds, government bonds. Talking about government bonds, those bonds which are issued by the government. US government bonds are called treasuries. UK government bonds are called gilts. German government bonds are called bunds, buxel. Uh, Indian government bonds are Indian government bonds. Then there are Japanese government bonds. French government bonds are called oats. These are some of the terminologies. Whenever you hear treasury yields or treasury market in US, they are referring to the US government bond market. This is exactly what it means. When you are buying a US government bond, you are giving a loan to US government, in return of which US government will pay you a fixed annual coupon, which is the interest. Till the time your bond matures, you will continue to receive that interest, and when the bond matures, they will give you your money back with principal. Now, the point is that when you buy a bond, you can also sell that bond as and when you like to. You don't need to hold the bond till its maturity. It's your choice. You want to hold the bond till maturity, you can. If you don't want to hold it, you can sell it in the market. Sometimes when you buy a bond, uh, it is giving you a percentage return of 5%, but in the market, when interest rates go down, suddenly the value of that bond which you have right now, the value of that bond increases, because you are getting 6%, in the market rates are down to 5%. So all of a sudden your bond becomes very precious, because anybody who buys this bond will continue to receive 6%. So you can sell that bond at a higher value, which means at a premium, and people can buy it from you. What will happen? You will receive extra capital on it plus the interest which you have gained, but you will not receive the interest for the remaining years, because now you have sold the bond to someone else. So you can do that with government bonds, you can do that with corporate bonds, obviously. So the government bonds are those bonds which are issued by the government, and as I said, government requires money for spending, and they issue bonds, and the rate at which they pay you the interest is the rate which is decided by the central bank of US, right? Corporate bonds, these are the companies which issue the bonds. As I said, that sometimes the example which I gave you, that if there are institutions, let's say a company wants to manufacture a plant which requires $1 million, they can issue 1,000 bonds of $1,000 value each, and they can raise money, and while they're using that money, they can pay interest to the bondholders, and by the end of a maturity date, they can repay that sum. So there are companies which issue bonds, companies like HSBC, Bank of America, JP Morgan. They obviously issue bonds, and they pay you a fixed interest also. Please note, government bonds and corporate bonds, the basic difference, the when government issues the bond, you're giving loan to the government. Corporate bonds are issued by companies. Obviously, your risk is much more higher in corporate bonds as compared to government bonds. The chances of a company getting bankrupt is higher than a government. So the interest rate or the coupon on corporate bonds is slightly higher than the government bonds, because you are taking an additional risk. So it depends. You can tweak your portfolio. You can put some government bonds. You can put some corporate bonds. Depends on your risk appetite. You can talk to your investment consultants also how it works. Right. That being said, there are some high yield or junk bonds, as we call it. High yield bonds or junk bonds. These are uh, uh, low quality bonds which do not have a good credit rating. And as a compensation of a higher credit risk, they offer a higher yield or a higher return also. So if you are buying a high yield bond or a junk bond, you should know that if this company is paying more interest than others, the risk is also higher. So that is what is called a high risk bond. There are floating rate bonds. As I said, there are fixed rate bonds, there are floating rate bonds also. Floating rate bonds where the interest is linked to the interest rates. So, I mean, if the interest rate goes up, you might get paid more. If the interest rate comes down, you might get paid less. Those are floating rate bonds. So you understand the difference between a fixed rate bond and a floating rate bond, right? And then there are also bonds which are known as investment grades. Investment grades are these high quality bonds which have a very good rating. So a lot of people, they only invest into investment grades, and it's also called IG bonds or investment grade bonds, and these are good quality bonds, as very different from the high yield. Then there are some bonds which are linked with the inflation. So if inflation increases, your coupon also increases. These are called inflation linked bonds, right? So all of these guys, all of these bonds, as I said, they are available in one or the other form. You as investors can always try to invest into these bonds, and definitely take advantage of this. There are municipal bonds, bonds which are issued by the municipal authority of a country. So you can also buy municipal bonds, and a lot of municipal bonds actually are very tax efficient also. So as compared to normal bonds, municipal bonds are more tax efficient. So you can always check and invest in those as well. Now, let's understand a concept which is called bond yield or bond curve. And this is a very important concept because bond yield is basically a measure of interest, takes into account the changes in the value of the bond. And there are different ways to measure the yield, but it's very simple. Normally, how you understand the yield, whatever is the current price of the bond and the coupon which it is giving. So if the bond price is $100, coupon it is giving is 5%, which is $5. If 5 divided by 100, 5% is the bond yield. Very simple. Yield is basically the total return which you will receive from the bond, right? So whatever is the total return you receive from the bond, that is called the bond yield. Now the curve which you are looking at, it's very simple. Years to bond maturity. On the vertical axis, you are looking at the return which you earn from the bond. So from the bottom to the top, lower to the higher. And on the horizontal axis, you see the maturity years. As you can see that the curve is towards the right side, upward sloping. That shows that a normal bond yield curve, how does it look like? A normal yield curve looks like upward sloping on the right, because as the number of years for the maturity increases for a bond, investors, they expect a higher return. It's very simple. If you give a loan to someone for 30 years, you know that your money is gone for 30 years. It will come back after 30 years. So you expect a higher interest rate. So you expect a higher yield. So as you can see, starting from the first year, 1 year maturity. So bonds have different maturities. Not all bonds are long term bonds. In fact, there are bonds which are called treasury bills, which have a maturity of within 1 year. So these bonds can mature within 1 year, and these could be the least riskier bonds to invest in, because you are buying a US government bond for 1 year and you're receiving an interest on it. So imagine in 1 year you don't expect US government to file for bankruptcy. So these are from 1 year to 2 years to 5 years, 10 years, 20 years, 30 years. So short term, medium term, long term bonds. As and when the maturity of the bond increases, the maturity years or the maturity duration increases, we see that a lot of a movement is happening in the yield. So it's a upward sloping curve. This is called a bond yield curve. Shows the relationship between the yield and the years to maturity. What I'm trying to tell you is higher long term maturity bond is more sensitive to the interest rate changes, because the long term maturity bonds, obviously even the yields of the long term maturity bonds are slightly higher, because under normal circumstances one person would expect a higher return from a bond which is going to mature at a longer duration as compared to shorter duration. So some points which we should remember: bonds can be issued by companies or governments, and they pay a stated interest rate, a fixed interest rate. Market value of a bond changes over time. It does not become more or less attractive to the buyers, but the market value of the bond definitely changes. There are high quality bonds which pay on time. There are low quality bonds which have that risk. So you get compensated by receiving a higher interest rate. Bonds that have shorter maturities, they tend to offer lower interest rates, right? Now we need to also understand, guys, that about um, when we talk about why are bonds bought and sold. Because investor now, you as an investor, you need to understand that why you need to invest in bonds. First is there is a predictable income stream to you, because typically bond pays interest on a regular schedule. If you are getting 5% a year, that will be paid to you every 6 months. So 2.5% in 2.5% in the next 6 months. So the distribution of, mostly the distribution of the coupon, it happens semi-annually. If you hold on the bond to its maturity, then you're expected to get the entire principal back. So bonds are basically a way of preserving your capital also. While you're investing, your capital is sort of protected, assuming that the bond issuer is very strong. Stocks a lot of times are very volatile. So sometimes you can take some money out from the volatile stock market, put money into bonds which you know that is going to give you a fixed income and is going to preserve your capital also. We talked about how companies, governments, municipalities, they issue bonds to get money for various things, right? Sometimes governments, they want to increase the consumer spending. Sometimes companies, they want to use your money for capital investments. Government wants to build schools, highways, hospitals, projects. So they borrow money from the people and they pay interest to them, right? So as I said, there are different ways, there are different benefits and different risk of bonds. We as investors, we need to know that these days bonds could be one of the best ways to invest in, and especially now when rate cuts are happening, we need to know that how bond prices actually move. This is important, right? A very important question over here should be that how the bond prices actually move, because at the end of the day, the movement in the bond prices is something which is very important. Why the prices of bonds are going up and down? Because bond prices move. You can actually buy and sell a bond at the market price, but the question is that what makes the bond prices move? What is the reason why the bond prices would actually move, and what determines the price of the bond? Bonds can be bought and sold in a secondary market. Once the bond are issued, you can buy and sell them in the market. So let's say you bought a 5 years bond and you held it for 2 years, you received your interest. After 2 years, you saw the value of your bond went up. So you can actually sell it, earn the capital gain, and now somebody else received that bond. So the rest of the coupons will go to that particular person, right? There are some bonds which are traded publicly through exchanges also. A lot of them are traded over the counter, where there are a lot of brokers, dealers, right, which are acting on the behalf of the clients. But a bond's price and the interest, basically, that determines the value of the bond. So obviously a bond must have a price at which it can be bought and sold, right? So there is always a price of the bond. It is issued at 100, but if the bond is really good, paying you a good interest, then the value of that bond can increase also. Bond yield, as I said, is the actual return which investor can expect if you hold the bond till its entire maturity. So yield is based again on the price at which you have purchased the bond, the coupon which you get, or the interest which you get. Now a bond price always move according to the interest rates, first of all. And you have to understand, as a bond holder, that it's a very critical feature of the bond market that you must understand the bond price. What does it reflect? If the coupons are coming regularly, the value of that bond is obviously higher, right? Also, as compared to the market. So in case of bond prices, yesterday when I was conducting the session on Fed interest rate decision, I We came across a slide where they talked about how rise and fall in interest rates can lead to the rise and fall of the bond prices also. And this is something which is really important. Understand this. Let's say, so in a market, bond prices are quoted as in terms of face value, right? So a bond which is issued at 100, it will be the 100 will be the par value. If it is quoted as 1000, 1000 will be the par value. If a bond is quoted, let's say 99 in the market, or 990 in the market, that means the bond is trading at a discount, because most of the bonds, they have a face value of either 100 or 1000 or 5000. So if you see that the bond price, so consider it this way: if a face value of the bond is 1000, the price will be quoted as 100. If the face value is 5000, price again can be quoted as 100, for example. But the point is that a lot of times we have observed that if the market price of the bond shows 97, for example, or shows 99, for example, which means that the bond is being offered to you at a discount. So if a bond face value is 5000, the price is 100. The moment that 100 becomes 99, that means that bond is issued at a discount, let's say at 4950. Or if the bond is issued at $1000, the price will be quoted as 100. The moment it becomes 102, which means the bond is available to you at a premium. The value of that bond could be 1020 now. So this is how normally the bond prices are quoted, right? Similarly, when we look at the interest rate understanding, how the interest rate actually prevails. So interest rate is the rate which is decided by the central bank. Today, when you go to a bank and borrow money from the bank, you pay an interest rate. Who decides that interest rate? Central bank decides that interest rate, that this is the interest rate which you as as a borrower will pay to the bank. Similarly, the interest rates are decided by the central bank. And when you buy a bond and become a bondholder, if you're buying a government bond, for example, and government is the issuer, they will pay you an interest depending upon what is the interest rate which has been decided by the central bank. So this interest rate changes. As I said yesterday, the interest rate reduced to 0.5%. Correct? Now, every time when an interest rate goes up or down, it gives you, or it moves your bond prices also. Why? Because let's say you bought a bond 1 year ago, it was a fixed coupon bond which pays you 5% interest. Now, yesterday, interest rates cut down by 50 basis points. So now the interest rate is 4.5%, which means any new bond purchases will pay 4.5% coupon. But the bond which you have purchased, that is giving 5% coupon because you have purchased a fixed coupon bond. So what happens to the price of that bond? Because now, while in the entire market new bonds are issued at 4.5%, your bond is the only bond which is giving 5% coupon. What happens to the price of that bond? The value of that bond goes higher, the price of that bond goes up. Similarly, let's say the bond which you have purchased gives you 5%, but central bank increases the interest rates, which means now any new bond issued will give you 6%, while your bond still pays you 5%. So the value of that bond, if you try to sell that bond, why somebody would buy that bond from you and get 5% coupon while in the market 6% coupon bonds are available, unless you sell your bond at a discount. So interest rates and bond prices have an inverse relationship. Now the question is, if you have a news that central bank is going to cut rates very soon and there will be a series of rate cuts, would you not buy a fixed coupon bond right away? And would the value of that bond is anticipated to go up in the future if you're expecting a series of rate cuts? Use your chat options, guys. Use your chat options to answer me this question. Will it be wise to buy a fixed coupon bond if we are expecting rate cuts in the coming future? It's a yes or no question. Just write yes or no. So we'll get an idea how much you have understood bonds as an investment. Just write yes or no. If there is a series of rate cuts coming, if the interest rates are expected to go down, will it be wise to buy more fixed coupon bonds right now, preparing yourself for the future? And what do you expect will happen to the prices of those bonds? Right? So basically, the idea which I'm trying to give is that there are a lot of such opportunities which come across, but we as investors sometimes are not aware that there is a fixed income bond. Now, before 2020, nobody would speak about bonds. Bonds would be only talked about people who were close to their retirement or people who um, had no source of income and they wanted safety. They would buy bonds, and bonds would pay them 1.5, 2% yield, and but it will preserve their capitals. They were happy to do it. But after 2021, 2022, interest rates were increased by the central banks to control inflation, and the same bond which would pay you 1.5%, 1% started paying you 5%, 5.5%. So that flocked a lot of investors toward bond-based investments, and that's why we are doing a whole session to make you more aware about the bond-based investments. See, it makes sense also a lot of times to why bonds could be your smartest move during this rate cut cycle. John Keynes, I'm not sure how many of you know about this, a very famous economist. A lot of theories have been designed and been written by John Keynes, and there's a whole Keynesian uh, theory of economics. John Keynes once said that markets can remain irrational longer than you can remain solvent. Remember this. Markets can remain irrational longer than you can remain solvent. So sometimes you might enter into trades thinking, okay, there is right now I'm in a loss, markets are irrational at the moment. But you might die out completely and markets would still continue to remain irrational. So we have seen historically bonds have shown very impressive performance during the Fed rate cutting cycles. If you see since 1980, bond markets have consistently delivered good returns. I mean, even when rates used to come down, we have seen since 1980 bond markets have consistently delivered substantial returns. A very notable example I must give you from April to June, and this was in 1980. There was a 11% rate cut coincided, and there was an exceptional 18% return on the Bloomberg US Aggregate Index. If you see between June 89 and September 92, between these 4 years, there was a 6.5% rate cut which happened, and bond market gave you 46% return in 4 years. Imagine that, right? Not sure how many of you were aware about this information, but it's there. So that is another major important reason that why it makes a lot of sense to invest into bonds during a rate cut cycle. And as we see, September is underway, and these famous words by John Keynes they resonate very deeply with the financial community, because now with Central Bank of US, which is Fed Reserve, now when they are delivering their first rate cut in years, the global equity market, they are moving record highs. Financial landscape, if you see, there is still a lot of uncertainty, and the environment is really volatile. So this is a critical question: where should you place your bets? And bonds is one of the answers, because a fixed coupon bond will is expected. As I said, there is no such thing as a guaranteed movement. But a fixed coupon bond could be a good idea because the price is expected to increase while the rates come down in the market. Your fixed coupon bond will still pay you the same amount of interest. So the value of that bond is expected to increase in the future as the rate cut progresses. All right. And this is a sea of unvolatility at the moment. As I said, historical trends have shown whether the rate cutting cycle of 1980s or whether we talk about 1989 or 1992, during the 80-81 cycle when the rate cuts were happening, annualized bond returns reached up to 99%, and that was something which was remarkable, right? And this is the evidence of how bonds have consistently thrived when the rates have cut down, because when interest rates drop, as I said, the bond prices they tend to rise and gives you decent returns. So you can choose bonds over fixed deposits, because as the interest rate would edge lower, bond is a more dynamic option as compared to your fixed deposits also, because fixed deposits do offer stable returns, but then the growth potential which bonds provide in a rate cutting environment, fixed deposits cannot provide you that. So bonds will also deliver consistent interest income, that is good, but then there is a capital appreciation advantage, because in a falling interest rate environment your bond might continue to go higher. If you compare fixed deposits, you are locked with lower returns. So it's not really attractive in these scenarios. So a lot of people would switch from fixed deposits and they would buy bonds with it. So it's a very strategic move, and it's a very cautious move if you would ask, because rate cut is not just happening in US, it is also happening in Europe. Soon it will happen in UK also, because you talk about European Central Bank, they have already begun the easing the policies, right? They've already delivered the second quarter point cut of the year. So this is a momentum which has started. Fed has already reduced by 0.5%, right? If you see closer to home, India's inflation rate is 3.5% easily. RBI could also reduce rates in the near future, right? Now that move could also boost the appeal for Indian bonds. So if you are, especially if you would like to check, Indian bonds also could be one example. If there is a slowdown, again, as I said, rates could cut down and the value of Indian bonds can also go higher. Investors are always reallocating from equities to bonds, and it depends basically on the risk and return ratio. Why somebody would want to take a risk in tech stocks if they are getting higher return in the bonds? So that's it. That was what we saw in 2022, right? So these are some really important points, guys. I'll quickly share now a bond portfolio with you. There are a lot of strategies in bonds, investment in investment grades, investment in treasury bills, which is US bonds. Sometimes there are pair trades. In an interest rate environment, you could short sell short term bonds and you can buy long term bonds, because long term bonds move more as compared to short term when interest rate cuts are happening. So a pair trade can also be found, and this is something which a lot of people not know about, but you can actually do a market neutral strategy between bonds. And then there are bonds like Eurobuxel, which is a basket of bonds you can buy in a rate cut environment as well. Now let me take you through a bond portfolio which is a fixed coupon bond portfolio. Just have a look at it, and if you like it, you can tell your relationship managers to send you this portfolio. But please remember this, that it's really important that you must talk to your investment consultants before investing anywhere. So I'm just sharing with you something. This is a specimen, and again, this is going to be mostly for your information purposes, and you can have a look at it. So this is the fixed coupon bonds play amid rate cut expectations, and this was something which we put around 8th of August. And if you see the major scenario, this is what we're talking about, that in July, Fed, they kept the rate steady at 5.2, 5.5, but later on when they saw that job gains were somewhat moderated, they hinted a rate cut in September, and which happened yesterday around 50 basis points, which was something slightly unexpected. 25 basis points was expected, but 50 basis point was actually a big surprise, and that pushed stocks higher a lot. That pushed euro as a currency higher. That pushed gold prices reach almost to $2,600. So obviously we were expecting a 25 basis cut, but it happened 50 basis points. Now, why fixed coupon bonds? Fixed coupon bonds advantages during interest rate cuts because the payment remains constant. You will continue to receive the same interest as the interest rate decreases. The existing fixed coupon bonds will become more attractive, causing the market prices to rise. And this benefits the investors because you get a capital gain, you get a stable income. And we are talking about US government bonds, we are talking about corporate bonds also, right? Because there are a lot of bonds which are floating rates, not fixed. But floating rate or newly issued bonds, they will offer lower returns. So there is no appeal on that. But fixed coupon bonds, they can offer better returns and stability, right? So there are these portfolios which you can see, like fixed coupon bonds. We are looking at these some corporate bonds like Goldman Sachs, Bank of America, Jefferies Financial Group, Ali Financial, and look at the yields at the moment: 6.4%, 6.07%, 6.5%, and this is yearly yields we are looking at. And coupon which is delivered is around $6.50, $6, 6.4. And like this, there are so many bonds now. Like for example, FSKKR Capital Corp, second last, is issued right now at 89 point, issued at 100, available at 89, and it's a fixed coupon bond. So if you buy these kind of bonds later on, the value of these bonds might go higher because they will present a fixed coupon. And these maturity, best part is the maturity of these bonds is 5 years. So these are short term bonds, so obviously less riskier, and at the same time available at a discount. So this is something, guys, which you must look at. As you see, the ratings are already given. These are all a lot of them are investment grade bonds, triple B, A minus, triple B ratings. So this is something which you can also check. And bond portfolios, again, as I said, guys, it's always good to invest into bonds. Um, Currently, as we see an environment where rate cuts are happening, it may not be the worst idea to be more inclined towards bonds. And these kind of portfolios are always available with us, and will continue to make more and more portfolios and keep you more and more aware, uh, to give you an idea that why it will be a good point. Even in your portfolio, as I said, since governments began to issue bonds, and that was in the earlier 20th century, it gave rise to the modern bond market, right? And investors have purchased bonds for so many reasons. In your portfolio, capital preservation is one of those, because unlike stocks, bonds, they repay the principal at a specified date or maturity. That makes bonds really appealing to the investors who don't want to risk losing capital in a stock, right? Or somebody who wants this money back in 3 years. They want to meet a liability at a particular time. Till that time they can invest and still get a fixed income, so it preserves your capital. So offering interest at a set rate, getting your capital back, you get a fixed income. Sometimes, as I said, in a rate cut environment, if you buy bonds, fixed coupon, capital appreciation might happen. Plus, it's a good thing to diversify, right? Why would you put all your money into stocks or commodities? You can always diversify your risk, put it into bonds, so you get a different asset class to invest in. Plus, sometimes again, uh, bonds can also help protect investors against if there's any economic slowdown happening. The price of the bond depends on how much investors value the income that bond provides. Most of the bonds will pay a fixed income which will not change. So if the price of goods and services are rising, which is basically inflation, a fixed income bond will become less attractive, right? Because inflation means the prices are increasing faster. So that is a problem. But if there is a slower economic growth, that might lead to lower inflation. That makes bond very much attractive, right? So this is, again, guys, these are a few important ideas you can always look into. Today's important information and session was about demystifying bond investments for you, and I wanted to do it just after FOMC because uh, now when the Fed rate cut cycle has begun, maybe in the December meeting and the next 2025 we might see more rate cuts coming in depending on the data. So this still not late to buy bonds with fixed coupon. And as I said, we have observed in the cycle of 80s and 90s and how bonds with fixed coupons have given phenomenal returns during a rate cut cycle, and it's one of those cycles which have begun. So do make bonds a part of your portfolio. Again, as I said, not just for the rate cut cycle, but also because they could preserve your capital, could provide you a fixed income. And definitely talk to us, talk to our consultants about which bonds to invest in. and definitely speak with your risk experts. And this is a very good tool to diversify you, so you must use it. That being said, we have reached to the end of this session, and thank you so much for joining today, ladies and gentlemen. And it's a pleasure to come every night and sit with you and talk about different asset classes, different products. Tomorrow we are going to talk about value investments. We are going to bring across some companies which are value based stocks, and we are going to discuss about that. If you liked my session, please go on Google reviews and under Century Financial, and please share your feedback. This really motivates us to continue good work and bring more and more sessions for you. As I said, that for the next remaining days, every single night there is going to be a topic to be discussed upon. So I hope to see you tomorrow 7 to 8 p.m. And till then, have a great night. Continue trade, manage your risk, diversify well, and I'll see you once again tomorrow. So you have a great night, guys. Thank you.